Hey, Russell, welcome back. I wanted to chat about this, that I have a lady up in Grass Valley that she came to me, says, Eric, I'm done with tenants. She just had to evict the tenant. Let's just sell my asset and I'm done. I just want to be done. And so she kind of had this impression that she was just going to pay like this much. She goes, I'll just pay all my taxes. I'll just pay my she maybe even used the word little taxes. But I kind of stopped her and went, wait. I need you to go talk to someone, because I'm not going to be at the surprise at the end when you have a little bit of taxes turns into this many taxes. So can you please explain a little bit about maybe how that looks?
Yeah, that's a great scenario. I hear this all the time from people. They think, well, I'm not going to do an exchange because I heard, keyword heard, that you're only going to pay like 15% in taxes. Yeah, that's physically impossible. It's physically impossible for anybody in the United States to pay 15% in taxes if they're selling an investment property, even if you live in a state that doesn't have state tax. And California, not one of those states. We're the heaviest tax state. The average tax in California is about 35%. Kind of how that breaks down is there's this blend of taxation. So first of all, you have capital gains. Like everybody's heard of capital gains. Capital gains is a tax based on the appreciation of an asset, right? You bought it for 400, you sold it for 600, you had $200,000 of appreciation. The appreciation is taxed as capital gain. That's 15 to 20% to the federal government, depending on your adjusted gross income. And in the state, it's just whatever your income is, right? And some people will tell me, well, I'm a senior. I'm on a fixed income. I only make $30,000 a year. So if you look at that, bracket of capital gains calculation, I'm not going to pay capital gains. Yes, you will pay capital gains because $30,000 is your income every year, is ordinary income, but you're selling a piece of real estate. You have $400,000 of gain in that real estate. That's going to become your income for the year, right? So for this year, you didn't make 30,000. You made 430,000, which impacts all of your other income tax as well, right? So the state's highest tax bracket is 13.3%. So let's say it's 10%. So you're somewhere between 25 to 30% just in capital gains. The other one's depreciation recapture, right? You take that wonderful benefit of depreciation every year you own it. Let's say you're taking $15,000 a year of depreciation. If I've owned it for 10 years, I've taken $150,000 of depreciation, which means I've lowered my cost basis by that much. So the appreciation is taxed as capital gain. The depreciation is also taxed, but that's at a higher rate. It's 25% flat rate to the feds. And then the state is still just income tax. So it doesn't matter whether it's appreciation or depreciation, it's going to be your 10 to 13% to the state of California. And then the last tax is the net investment income tax, more commonly known as the affordable healthcare tax of 3.8%. So when you blend all those together, yeah, the average is more like 35%. It can be over 40%. So you never want to sell and close without knowing what that tax hit's going to be if you're not doing a 1031 exchange.
Awesome, Russell. Thank you so much for sharing that. And if you guys missed the other videos of where to put your money or the options you can choose to be able to not pay that tax, listen up and go to the other videos. All right. Thanks, Russell. Appreciate it.
Thanks, Eric. Always a pleasure.